Hey guys, so this is a guide into mastering price action trading. Price action is the ability to interpret the behavior or the action of price in the market at a glance without using any indicators. Some people call it naked charts. In other words, when you open any Forex market, just by looking at it, what is the first impression that you get about what the market is doing? Under price action, we have different concepts like candlesticks, market structure, market patterns, and key entry levels which are influenced by the forces of supply and demand in the market. The aim of understanding price action is, number one, to get to a point where you can easily tell whether there is clarity in the market in terms of market direction or not. And if so, where exactly is the market likely to head? Number two, what is the immediate bias of the market in terms of strength and weakness? As we know, in any market, it's always a constant fight between buyers and sellers, and each one of them is always trying to overpower the other. So the immediate bias is just to help us understand who is currently strong or weak in this specific market. And finally, through price action, we should be able to tell what specific levels will be suitable for getting high probability entry setups versus the poor levels that you need to avoid. Price action is very wide, but in this video, I'll cover very specific concepts that I consider very important. Then eventually, I'll show you how you can combine all these to read and interpret any kind of market in a way that you can easily make a prediction of where the market is most likely to head, and also how to find the entries. The first concept I'll break down is candlesticks. This is not an in-depth candlesticks masterclass, so I'll just be sharing with you the most important aspects that you need to understand in terms of price interpretation. Candlesticks represent price movement. So when price is buying from that point to that point, it will be represented by something called a candlestick, which you can see here. And the more the price is fluctuating, the candlestick also keeps moving and changing, adjusting its size depending to how far price will move. When looking at candlesticks, we have very many candlestick patterns, but the most important thing any trader needs to know is how to interpret each candlestick from a perspective of strength versus weakness. A candlestick has got two parts, that is the body and the wick. The body is this part that is filled in with this color, and the wicks or the shadows are these tails above and below. Each candlestick represents a certain time frame. For example, I am on the 4-hour time frame, which means every candlestick shows how price behaved within a specific 4-hour period. Now, the body represents where we had the solid momentum during that time span. And I'm saying solid momentum because you can see above and below we have the wicks. Now, what the wicks mean is simply that at some point this market was buying all the way up to that point, but by the time the 4-hour was closing, these buyers had been dejected all the way downwards. So that wick represents evidence of rejection. But on the other hand, where the body is, there was no rejection, meaning we had that solid momentum. Long bodies indicate strong momentum and short bodies indicate weak momentum. Same thing with wicks. Long wicks represent strong price rejection and short wicks represent weak price rejection. It's very important to understand how to interpret each candle based on the length of the body versus the wicks, and not just because it was bearish or bullish. If you look at this candlestick at a glance, you might say that the market was bearish during this 4-hour period. But just because the market was bearish does not mean sellers dominated that period, because we are very interested to know who is strong and who is weak in this specific market. This candlestick is red and bearish, but you will realize within that specific 4-hour period, buyers dominated the market more than the sellers, and here is why. Now, if I zoom in and you look at this candlestick, I'm just going to go on the side so that you can understand. Price opened on this line, but I'll put my arrow on the side. So from that line is where sellers started running. So this candlestick started selling at this line, meaning this line was the opening price. It went up a little bit. But if you look during this 4-hour period, there's a point where price sold all the way to this low. So that means at a certain point in time, sellers were completely dominating this market. However, by the time the 4-hour candlestick was closing, which is here, price moved all the way from this low and was pushed all the way back up. That means during this 4-hour period, sellers only ended up closing with this solid momentum. Now, if you look at this arrow, it's showing us a clear representation of where the solid momentum was left. On the other hand, I want us to look at the buyers during this market. The fact that price sold all the way low, then went all the way back up, it simply means sellers had pushed price low, but buyers are the one who pushed price back up. Because you need to understand that the fight is a constant battle between buyers and sellers. So if sellers are being pushed up, it simply means they're being pushed by buyers. So by the time this candlestick is closing, This is what the selling momentum was looking like at the close, and this is what the buying momentum was looking like. So the candlestick can be bearish, but it doesn't necessarily mean that sellers are strong in that market. This is a perfect example. So even though this was bearish, it still shows that buyers had more strength within that 4-hour time span. And you can go ahead to look that even after that candlestick, we had more bullish candlesticks coming in, and the market continued going up, respecting all that we have just discussed down here. So always make sure to check the details of the candlesticks and don't just look at it because it's bullish and think it automatically means that buyers have an upper hand in that market, and vice versa. Now the next thing you're going to look at is market structure. We look at it from two perspectives. The first one is in terms of market direction. The second one is in terms of specific structural levels that are good for entry and those that are bad for entry in the market, and why. In terms of direction, start with an uptrend which has higher highs and higher lows. As long as we see this sort of structure repeating itself, that is an uptrend or a bullish market. Then a downtrend has lower highs and lower lows continuously. Going back to the uptrend, it has to maintain this series of higher highs and higher lows. However, if at some point in time the market comes and violates this low, meaning instead of getting a higher low, we end up getting a low that closes and breaches the previous one, it simply means it has violated what we are looking for, or it has violated the structure. In this case, we'll say we have something called a break of market structure or a shift in the market structure, meaning we are anticipating this market to potentially reverse from being bullish to bearish. Remember, I said potentially, so I did not say this is a guarantee that the market is reversing. Every concept you learn in trading, you have to understand it independently. However, you still must combine this with other tools of analysis, other confirmations, and other confluences to just increase the chances of your decision making being right. Same thing applies on a bearish market. We need to maintain this series of lower highs and lower lows. But if at any point in time, this previous high, the market comes and violates it, meaning instead of us getting a new low that is somewhere here low, then the market continues to drop, price goes all the way to violate and closes above this high. If that happens, it's a sign of a shift of market structure, and there's a possibility that this market can reverse from being bearish to potentially bullish. Any market that is moving sideways is simply consolidating and not the best for getting entries. The next thing I'll be covering is the structural entry points. There are levels which are better for entry than others, and we have levels that if you get an entry, you are most likely to get stopped out. If you look here, we do have an uptrend, meaning we have higher highs and higher lows. We usually have some sort of confusion whenever the market gets to previous highs in an uptrend. So at a previous high, you are likely to see consolidations happening or the market ranging. And this is because the market is not decided on whether it's going to break up or whether it's going to reverse. But eventually, regardless of the decision, what you'll come to understand is anyone who was trying to take entries at this previous high was most likely stopped out. And of course, I'll be showing you examples from the real market. Now, what we do have here is CAD JPY just in the past, I guess, 1 to 2 months. This is a very clear market that has higher highs and higher lows. The focus here will be on previous highs. For example, at a certain point in time, we had this bullish impulse, we had this retracement, and another impulse. Now, what I've told you is you don't want to be taking any entries at a previous high. So this is the first high of this market. I'll mark it to just show you what price did the next time it tried to penetrate through the high. In the real market, whenever price will get to this level, we're going to have some sort of rejections because it is still contemplating on whether it's going to break through or whether it's going to reverse. So in a bullish market, one of the worst structural entry points is buying at a previous high. If you bought here, that's your first stop loss. If you try to buy here, that's your second stop loss. If you try to buy here, that's your third stop loss. So all of this, you've hit stop losses because you are buying at this previous high. I'll show you another example. We do have another high here. So I'm going to mark that high as a zone. So this is the high at the moment. So price is selling, goes back to retest that high. When price retested this high, the first thing that it did is we started having small bearish rejections. Now, someone like myself, I do trade using a 15 pip stop loss. You can already see here the market is making very significant retracements. It simply means if you go on the small time frame like the M15 and you try to take a buy here, there's a very, very high chance you've already hit your 15 pip stop loss very, very easily. It's also possible that you hit more than 1 or 2 stop losses. Now, see if that's not enough, I want us to focus on the latest high, which just happened actually last week. because this is 22nd January, just a few days ago. Look at that last high. Same thing. It keeps on repeating itself. So I'm just trying to show you this for you to believe that if you want to hit stop loss in a bullish market, try taking trades at a previous high. Look at that. We have that previous high. The market starts retracing. After retracing, it starts going back up. After going back up, I want you to see the number of rejections that we've had at this high. When it comes here, if at all you do get any entry here, you probably hit stop loss number 1, hit another stop loss, you hit a third one, and potentially you can even hit a fourth stop loss somewhere here. So what is the best level to enter the market in a bullish trend? Wait for it to retrace. Then as it starts to make this impulsive move, you can take your bullish entry anywhere here. You can take an entry anywhere in the middle, but just make sure you don't take any buy positions somewhere close to the previous high. So the more price is approaching the previous high, the better it will be for you if you've already exited your positions. The opposite is true for a bearish market, so I won't take much time since you've already understood. Now, ideally, the market is supposed to come and create a lower low. The price will be trying to break this low. It won't be smooth. So what will happen realistically is that the market will come and try to break this low, but eventually we are going to get many consolidations. Reason being is because the market is still negotiating on whether it will actually break this low and continue the downtrend, or whether it's going to reverse from here and now we have a bullish market. So here we do have a lower high and a lower low type of structure. So again, on paper, this looks very smooth, but I want us to now start focusing on the details, right? We do have this low, we have this high. Then the market is trying to form a lower low. I want us to go and mark how it behaved when it was trying to break the previous low. Just want you to come and check. This is the previous low at the moment. As you can see, whenever price is retesting the previous low, we have so many rejections. So if you are trying to sell here, someone like me who uses a 15 pip stop loss on the lower time frame, here I would have easily hit my stop loss very, very fast, because we had a whole more than actually 60-70 pip retracement. So if I'm trying to take any sell position here, I lose my money. Now the market starts to come down. Then let's say I take another sell position here. You can see it went a little bit down, but after going down, it again went all the way back up. So you easily have hit stop loss just by taking trades at previous lows. So the smart thing here would be wait for it to come and break the low, as you can see here. Then after it's done a pullback, you can now continue taking entries all the way up there. The market continues dropping and we have another low here. So let me just do this as the final one. From this low, the market goes all the way up, and sometimes it can even go for a whole 1 or 2 weeks. But it doesn't matter. The day that it will come back to this previous low, I want you to see. When it came back to that previous low, we had several rejections. The first one was somewhere here. If you try to take any short position here, you lost your money because it went opposite you. Came back all the way down again. You take a short position, you lose your money. The final thing is the key entry levels, and in this case, I'll be using the support and resistance, whereby support is anywhere in the market whereby price is above. And whenever price comes at that specific line or zone, it keeps on bouncing back up. So that is called a line of support. And the resistance is any line or zone somewhere above, and price is currently below it. So whenever price goes to that resistance line, it keeps on bouncing back downwards. The idea is you want to be taking short positions at a resistance level, and you want to be taking buy positions at a support level. Now, when support comes and crosses downwards, it turns into resistance, and vice versa. When resistance goes all the way up, it now turns into support, meaning if price comes here, this will now be a support level. We'll be expecting it to be bouncing back up, and that pattern keeps repeating itself. A perfect example of a support resistance level will be somewhere like here in the market. Now, whenever price is above this line, it is support. Whenever price will be below this line, it's resistance. This is the first example. Price was selling all the way downwards. The minute it touched this line, even though it eventually continued selling, you can see that we had that rejection there. So it shows you that that is a very significant level of support. We also have a second point in future. Price is selling quite well, touches that level, bounces all the way back up, gets rejected for a second time. Here's the third time. Price is selling, touches there, bounces up. Fourth time, price is selling, comes here, touches, bounces. Price sells, touches, bounces. So that is a very, very perfect example of a support resistance level. Now, the advantage of these zones is that they'll be helping us to get buy entries in the market. After you've identified this level on a higher time frame, your work will be now to narrow down on any small time frames, and you look for that zone. And if at all you are trying to buy this market, you'll be looking for buy positions at that daily support level. And I want you to see that you could have identified this level all the way from the daily time frame, and from the lower time frame, if you are trying to take buy entries here, you can see price respected this entry very, very well. If you took a buy position, it bounced off going all the way up. And also at some point it came back and retested, as you can see, took another buy position here, it's continued buying until now. So this is just a perfect example of how you can use these levels from a higher time frame for you to know where you'll be trying to buy in the market, and then you come and narrow down on a lower time frame. Here's another perfect example. As you can see, if I can scroll back some time in the past, you will see that we also had this support level. It is the same level that we have been using from the previous example, but then price is selling. When price touches that line, the first reaction is a bullish reaction. So assuming you've already identified, let's say, an uptrend from a higher time frame, and you are trying to buy this market, but you're not sure where exactly you're going to be getting your buy entries, one of the things that you want to do is identify your support levels. Then you'll be trying to buy at a support to increase the chances of the trade actually working to your favor. And the opposite is true for resistance. If you're trying to sell in a downwards market, after identifying that the market is bearish, mark your resistance levels and wait for price to now come back and bounce off at the resistance. In that case, this is how it will look like. So price is in a downtrend, right? It comes and goes down. So when it goes down, the support turns to resistance. So in this case, you'll be waiting for price to go back to the resistance, and that is where you'll be trying to find your entry. Ideally, from the higher time frame, you will need to identify several levels for you to find a perfect entry. Like here, I've just identified one level. But if you're trying to buy, sometimes the market can come to the first level and it does not give you any entry confirmation. So it's always important that you try to identify 3 to 4 levels around where you want to buy. Then you go with the one that will respect everything that you're looking for in the market as confirmation. That's it for the concepts. I'll try to show you a brief explanation on how you can actually apply this to read and interpret price. Now, the thing with price action is that I'm not teaching you any specific trading strategy. What I'm just teaching you is being very, very conversant with the market to a point that you can read what the price is doing currently and even try to make predictions. A perfect example is currently on AUD/USD from the daily time frame. If I look at the structure of the market, it's very, very clear that we do have lower highs and lower lows all the way from somewhere on my left chart to my right chart. So this market is actually heading downwards. So based on the structure, this is a bearish market. From then, I could decide that in this type of market, I'm expecting this market to drop. So the market has been forming lower highs and lower lows. Based on what we've just studied right now, we expect this market to continue dropping because at the moment, as far as we are concerned, this market is in a downtrend. Now, assuming the structure changes, that will be a different case. But if I'm to analyze this market based on what I'm just seeing right now, I am expecting this market to come and retrace, which it has already retraced, and eventually come and continue forming a new low. Whenever the market is trying to break the previous low, we always have some rejections. So as someone who already understands that this is how my market will look like on AUD/USD, the prediction is downwards, right? But even as the market will be selling, we want to be keen on potential levels where we are likely to hit stop losses. One of the levels where we are likely to hit stop losses is at previous lows. So I'll come and mark my previous low. On this market, I'll be confident to look for short positions, but the minute price touches this level, I'm already expecting a possibility of what? Some consolidation, and it could actually end up reversing to be bullish, or it could just consolidate a little bit and then eventually it continues to sell. Even if it continues to sell, if it gets to this other level, I'm still expecting it to have some disturbances before it actually breaks out. That being said, on my lower time frame where I find entries, the minute price will touch this level, I'll be avoiding to take short positions on AUD/USD. So this is how you just interpret price based on that knowledge of structure of the market. The last thing I want to show you is how you can get the confidence to enter your market. Since this market is heading downwards, one of the things that you want to confirm is by the time we are entering the market, there is some evidence of momentum. Now, if you check carefully, a few days ago, we had this significant long bearish candle. And as we know, long bearish candles signify that we have strong sellers in this market. So this is a very good sign that AUD/USD could continue dropping. However, if you look at the same market, it's currently having some consolidations, and I can tell you why. If you check a little bit left, you will realize that this was also a previous low somehow. It's not the main trend, but yes, it's still a low. Now, remember what I told you, whenever price gets to previous lows, there's a very, very high likelihood of consolidating or having some rejections. So at the moment, I am bearish on AUD USD. However, I'm smart enough to understand that even though I'm bearish, I just can't come and sell anywhere. So at the moment, this is how I can find my entries. Number one, I'd wait for this market to continue retracing, but the minute it gives me a fast, long bearish candle, I'll have the confidence to now come and take a sell position. The other thing that I could do is I'd wait for this market to come all the way and break out of this previous low. Now, the minute we have that breakout from that previous low, I'll be very confident that this market is completely bearish. After determining this from the higher time frame, my work becomes very, very easy. So on the lower time frame, I'll just be looking for entries at the resistance levels because I'm already clear on the market direction. But what I'm just waiting is for the right timing. So I hope this long video has assisted you to have a glimpse into price action, to know how to read the structure, to know the levels that are bad for entry and the levels that are good for entry. The best thing about price action is you can almost look at any market and make a prediction on where it's most likely to head next. And as long as you can call out the market direction, your work is just to look for the precise entries using the support resistance levels. So that's it for this video. If it has assisted you, be sure to drop your comment below and don't forget to subscribe.